Good morning, traders. My name is Bennett Tyndall with TradingAnalysis.com, and this is our Elliottwave Wednesday live stream. So traders, good morning once again, and thank you all for joining us. Guys, the markets continue to shake off any potential headwinds and remain extremely resilient. We have seen tensions between the United States and China escalate as both countries continue to investigate the coronavirus and its potential source. The economic impacts of the coronavirus will certainly have an impact on China's ability to fulfill its phase one trade deal obligations. So at the end of the day, the market just really doesn't seem to care. We've seen an incredible run breaking past 3,000 in the S&P. We've also seen a significant recovery in oil, which really wasn't too unexpected given the fact that we had that completed motive impulsive 5-wave move to the downside. But guys, overall, the market continues to remain and turn bullish. We get it. Nobody is interested and nobody wants to fight the Fed. I don't blame them. If you take a look at the top 10 stocks in the S&P 500, the top 10 holdings of the S&P actually account for 25% of the overall index. And of those 10 stocks, 3 companies, technically 4 stocks, since you have Google Class A and C shares, make up some 15% of the overall index. So you'd be a fool not to realize these names can carry us higher. In fact, we've also seen a resurgence in healthcare, now just 5% off all-time highs and some 35% off the lows. Kind of traditionally viewed as a defensive sector, although more recently in today's times, especially given COVID, turning more kind of offensive than a defensive sector. Another very interesting point is you take a tape like yesterday. So yesterday we had several of the beaten down sectors in the lead. Financials were up 5%, followed by industrials 4.2%. And if you look at a lot of the quote, stay-at-home stocks, many of those saw profit taking, which tells me that the market, and more specifically investors, are becoming more confident in the reopening of the economy and perhaps a possible vaccine on the COVID front. You take all of that into consideration with the fact that we do see a reduction in the number of daily hospitalizations, the number of daily deaths in the key kind of hot zones, such as New York, and kind of goes to the market's point that we've seen this incredible move. But all the while the market's been rallying, we've seen unemployment skyrocket with jobless claims surpassing 36.5 million in the past 8 weeks. You add to that retail sales down 16.4%, but once again, the market just doesn't seem to care. It's shaking it off. So, guys, what kind of a picture does this paint moving forward? Well, certainly investors don't seem to care about the absolute disconnect between the real data and the market. As Kramer put it last week, Maine and Wall Street have officially moved out and are living under separate roofs, or as I like to put it, they're marching to the beat of entirely different drummers. So, traders, short of a second round of COVID-19 cases, and with the continual decline in the number of cases combined with the gradual reopening of the economy, and the lows are very likely in, many of the industry groups that did contribute to the jobless claims can now begin to reopen as states kind of ease the stay-at-home and sheltering policies. But guys, as traders and investors, we always need to be aware of multiple possibilities. And at this point, at least in my opinion, the only way that this rally turns counter trend or corrective, meaning we do have a C-wave decline to come, is in the event we do see a second round of cases, a return to sheltering in place, and perhaps some sort of escalation on the U.S.-China trade front. We've been asking ourselves this question for the past several months. Is this recovery effort the start of a new uptrend? And from an Elliottwave standpoint, we could very well count this correction as completed in the form of the fourth wave flat. And from a psychology standpoint, it actually fits the bill quite well. But as we pointed out, we've had far too many variables to definitively call this the resumption of the higher degree uptrend. We're not virologists, right? If we do see a second round of COVID and states once again return to shelter in place, then absolutely we could see a push back to that 1800 support in the S&P, which we've noted on the historical monthly time frame. But guys, this is really why we love the Elliottwave theory so much. It gives us context in the event plan A does not go your way. And in times like these, stock selection is absolutely key. And more important than stock selection is portfolio construction. And in fact, that's what Todd Gordon and the team of Ascent Wealth Partners focus on with their clients. And speaking of the team, let's go ahead and bring them in. Good morning, gentlemen. Todd, Terry, Alex, how are you guys doing?
Hey, Bennett. Hey, team. How
are you?
Guys?
Doing good. Doing good. How are things in Serbia on the other side of the globe there?
Oh, Serbia is wide open, so we are walking freely as a free man and woman and child. So bordering are opening, I think, shortly in a day or two. So good to go. Everything's fine.
Awesome, awesome. Todd, glad to have you back with us once again. How are things in your neck of the woods?
Everything's good. Everything's great. Beautiful open there, Bennett.
Appreciate
Very
it.
complete from a fundamental, technical point of view. Really, really good job there.
Thank you.
Everything's good. We're, I don't know. I'd push it out there to say we might have the best weather in the country here in upstate New York. It's been 80, 85, sunny all Memorial Day weekend. I know. Or I don't know. Where are you guys in Texas? How are we doing? Are we ripping heat and humidity?
From thunderstorms to
It's actually
humidity.
not too bad.
It's not bad. Okay.
All things considered, it's not too bad. You know, when I moved to Texas, they told me this is the only state that you could experience all 4 seasons in a 24-hour period, and they weren't joking. They weren't joking at all.
That's fun. You know,
That's cool.
again, it was 85 and sunny. It was 90 here yesterday. We had snow on the ground 2.5 weeks ago.
Oh my gosh.
Oh my God.
All's fine. All's fine. You know, we're slowly getting back to normal. Slowly opening up here, step by step in Saratoga. Everybody's wearing a mask. It's pretty much mandated in New York, and you know, we'll see. We're taking it step by step, so everything's fine.
Good deal, good deal. Well, guys, we have a very special guest lined up for you this morning. Before we get to that, I'm going to just cover really quickly the count in the S&P 500 and highlight a couple of other charts just briefly. I don't want to take up too much time. As mentioned, we do have a special guest lined up that I want to get to. So, guys, as mentioned, the fourth wave flat, we've talked about this numerous times and the possibility that we are resuming that higher degree uptrend. Taking you off the daily and down to a 195-minute half-day time frame. Off the March 23rd lows, 5-wave rally up in 1, beautiful 3-wave correction here in wave 2. Within the higher degree wave 3, we have a nice extended third. We do have an acceleration gap within wave 3 of the higher degree third. We came to the completion in wave 5 in an ending diagonal. Then we enter a period of sideways consolidation. We're going to come back to the sideways consolidation here in just a second in the SMH. From there, we have equality of corrective legs C versus A, and we have since broken through this period of consolidation. So we were essentially kind of sideways, right, in a period of consolidation in kind of a 5-wave swing format before now breaking higher. We do have a decent zone of resistance between 3070 and 3100, call it in the S&P, looking for that wave 5 completion. Now, could this become even more fractal and we don't see as significant of a wave 2? Absolutely. But I do think we are in store for, at the very least, a brief little 3-wave swing to the downside. Wouldn't be surprised to see 3100 tapped before that happens. But from a longer term investment standpoint, I'm waiting for a bit of a consolidation and correction prior to deploying any additional capital. So in the S&P, let's take this conversation to the NASDAQ, as the NASDAQ semiconductors have been absolutely leading this market. We have a very similar count, except in this particular instance, we're tracking a possible expanding variety ending diagonal, which should complete a wave 1 of a higher degree, thus putting us into a corresponding wave 2 correction. If we take this to the SMH, semiconductors have been doing extremely well. The sideways consolidation that we saw actually resembles that of an Elliottwave triangle. 1, 2, 3, 4, 5, post-triangle thrust. Another interesting note here on the post-triangle divergence out of this fourth wave consolidation. If you were to take an extended trend line from this contracting variety triangle, you can see that's kind of where we found support within that wave, most recent green wave 4. Within this fourth wave triangle, it's very beautiful, alternating 61.8% relationships in D versus B as well as E versus C. I think the SMH gives us a very clear post-fourth wave situation, which is kind of similar to what we saw in the S&P as well as the NASDAQ. So we do continue to support and remain in favor of the bullish side, given the Fed support and giving the reduction in the number of cases as we discussed in the open. But we do think there could be a little bit of a correction near term. Looking at Apple, right? Apple and Microsoft make up 40% of the XLK, the Sector Spider Technology ETF, and over 10% of the S&P. Kind of a similar situation. We're tracking a fourth wave, a fifth wave in possible completion into this fib extension zone. Last chart for you guys, we've got the chart of Microsoft Microsoft, another very large component of the S&P, also a very similar kind of fifth wave diagonal pattern potentially in store. So guys, we've got a guest lined up for you. Go ahead, Todd.
Before we bring her in, can I just underline one thing that I think is really important? It's a chart that we discussed months ago, and it's something that I think we'd be remiss not to mention in terms of the low, the C wave low. Can you flip the screen to me real quick? And I think you guys might remember this chart.
Yep, stand by, making you presenter now.
Okay.
All right, presenter status is coming your way.
Perfect. You guys remember this? I used this chart yesterday. I did CNBC yesterday talking to Melissa Lee and Kelly Evans about this. This one just blows my mind. And again, I've used this. I posted on Twitter. I got a big response, which, you know, the original sell-off after COVID was our reality. People kept saying, are we going to get a retest of the lows? And as Bennett very eloquently put, we may get a retest of these lows, but what if this was the retest of the December 2018 lows? And this kind of thing, even though I've transitioned to longer term portfolio management, I'm always going to look at these relationships because they're right there in front of you. If you look at the last two significant lows, or I would say bottoming periods, you had 2010 to 11, 15 months. October 14 to February 16, 15 months. December 2018 to March 2020, 15 months. I mean, just unbelievable. Amazing. Isn't that crazy? And I don't think a lot of people came up with this. I don't think a lot of people saw the relationship. So perhaps that was the low. And as Bennett was saying, you know, maybe that was the C wave low. Looks like my charts are freaking out here in a sec. You know, that was potentially the wave 4 low. So the last thing I would say before we bring in the guests, and I don't want to take any more time, is I think it's healthy, and this is the heart of the discussion we had yesterday on CBC, which was, so technology, as Bennett just showed, Apple and Microsoft, even XLK is starting to take a little bit of a breather as the old school, you know, more deeply cyclical stocks are coming back online. Technology is taking a bit of a breather. That's completely healthy. NASDAQ is just below the all-time highs, where the S&P is still kind of working into that 786 retracement. So there's going to be a little bit of decision, and if, you know, we could just get a pullback from just shy of the all-time highs in the NASDAQ as the S&P responds to that 786 retracement, we regather, and then we'll see whether it's industrials and so on and so forth that, you know, that take us to new highs. But amazing action in the airlines, casinos, retailers, even the cruise ships have been strong recently. So it's nice to see some stocks besides tech join the party. I think ultimately that's bullish. As Bennett, you just said, the others are consolidating. Big cap tech is consolidating below the highs. So I just wanted to insert that.
Very good. Appreciate it, Todd. No, that's a fantastic chart to bring up, and it does fit quite well, that C wave decline that we saw kind of as the COVID capitulation played out. So very good. Let's go ahead and switch presenter back to our guest here, if I can find that window. You guys fill the space. Todd, would you do the pleasure of introducing our guest?
Absolutely. So Amelia Bordeaux is a good friend of mine, a good friend of the business. She comes from a lot of institutional experience in the FX side. She was at UBS. She consulted. I got to get the straight story in this one. In terms of consulting for the Federal Reserve Board in Washington, is that accurate?
Yep. She was an analyst in the international finance, I believe it was.
Yep.
Yep.
So I know she did a stint at UBS. I know she was at Westpac. She was on the institutional sales side. She was on the analysis side. She's got a lot of good institutional experience. Very, very enthusiastic person who really gets out and lives life to the fullest. If you follow her on social media, she's running like a marathon a day in Florida, making the rest of us lazy people look like complete losers. She's doing it right, and she's just a wealth of information. We did Money in Motion, CNBC show for 2 years together, we had a lot of fun. And then We've crossed paths many times on TV. So talk about somebody who's got real life, institutional, big money, what they call real money in the FX side experience. And then I asked her for years to transition to retail in terms of the trade education and this business that we're in. I said, you know, it's a great business when you get a good group of core clients, and that's what she's doing now. So welcome back to the show, Amelia. Thanks for joining us.
Well, thanks so much. Thanks for having me. Thanks for the introduction. I'm happy to be here, coming at you from Florida today.
And Bennett, jump in there, but just based on that opening kind of introduction, how is your transition going from institutional to retail? And maybe you're perhaps still dealing with some institutional clients, but you know, we had a lot of conversations over a long period of time about going from big money people, you know, billions and billions of dollars moving huge size, to the retail guy who's obviously trading similar markets, but it's a whole different approach. What are you finding?
I'm finding that it's great to work with the retail folks, and the individual investors is always a lot of fun, and talking about what issues and problems or challenges that they're encountering and trying to help, you know, mitigate those for sure. That's great. I love doing that. I guess the retail investors and working with them, it's just more like, because I have a macro approach, obviously a top-down kind of cross-market approach to trading foreign exchange. And so you kind of have to stay on top of a lot of things, and you kind of have to keep working at it. So it's not just kind of like a one-and-done course or seminar. I think all trading is like this too. I'm sure you agree. You have to constantly work on your skill set and on your trading. And so it's a process. And so you know, if you're an individual investor or retail trader, you just have to, you know, you have to stick with it. It took me a long time on the trading floor to move, you know, into senior levels and watch books completely alone, you know, with no oversight from another trader. So yeah, it's definitely a process, but it's big macro markets right now. These are markets that we call macro markets. They're directional. There's a lot of event risk. And the reason why it's so exciting is, I mean, just look at the headlines over the last, say, 24 hours. In terms of event risk, there's 3 types of event risk that I watch in the market, and they're all happening simultaneously. So the first type of event risk is external shock. And that's kind of like, obviously the coronavirus is an external shock, but also these vaccine announcements are external shocks. The results of the phase 1 and phase 2 clinical trials, will they be good? Will they be bad? They kind of come out, and yeah, it's interesting how they're announced. And I went onto the World Health Organization website, and they list all of the clinical trials that are currently occurring and the phases of the clinical trials and kind of when the phases will end. So I try to look at that and get some sense of like when there could be an announcement that can impact, you know, the equity markets. And the third type of event risk we're seeing now is political and geopolitical event risk. So we have external event risk, we have economic data event risk, which are really bad, and we have political and geopolitical event risk. And we're seeing that in terms of like what's happening in Hong Kong right now with the security law that Beijing is trying to impose on them. And that's kind of like US-China trade war. And if we look more domestically, just here in the United States, from a political standpoint, we have the openings across America of the states, and people are protesting and some aren't, and some states are opening at a kind of more rapid rate than other states. So we're just watching that as well. And all these things are happening at once. So very exciting time.
It's a good point. Like, and Bennett, I want to let you step in with your line of questioning, but for my, you know, short 20 years of trading, we generally avoided trading biotech because it's so tricky to time the testing and the approval with the FDA. They can be quite volatile. All of a sudden, we have an entire U.S. stock market that's trading like a biotech.
No.
But, you know, but I think there's this perpetual underlying bid with the Fed being extremely strong and being sort of a tech-led rally. But that's really good points. The last question I'll ask is, you know, all the days tend to blend into one, being a trader, as I've transitioned out now towards money management. Is there more event risk in the three sources of event risk that you mentioned? Is there more now than there was, you know, in the credit crisis in 08, or perhaps the 2000 tech bubble in 02, 03 when we had some domestic corporate fraud? Can you think back and say, honestly, and this isn't a gotcha question, like, is there more happening in the news flow now? And is that a result of the sort of the digital information age and the speed at which information is disseminated? Was it always coming out at this pace, or do we just know about it quicker now?
I think we definitely know about it quicker now. For instance, I think is it the BEA? The US government data releases used to be given to the press 15 to 20 minutes early in what was called a press lockup to write about. And because of coronavirus, they stopped that just because they didn't want to give the information out digitally, release it first to the press, because the press had to be like at the BEA or BLS in Washington, D.C. in the physical building. And they couldn't do that because of coronavirus. So it was interesting that they just put out a statement, the government, saying they're no longer going to release anything early to the press because they're assimilating it so fast as soon as it comes out in real time that there's no need for them to have a press lockup anymore. And they learned this because during coronavirus, there was no press lockup, and the press got the news the same time that it hit the market, and they were able to write about it like instantly. So things are moving along a lot faster. I worked in the markets back in the 2008, crisis, the global recession, the Greek debt crisis. You remember all that, the European banking crisis. Yeah, things. I wouldn't say there's more going on now than then. But there was certainly a ton of events. I mean, there was like a new headline on Greece like every single day that was just blowing up the market. And it was crazy.
It drove me insane, right? I mean, from a FX point of view, I was still primarily trading for the FX fund at that time. I thought the headlines coming out of the peripheral Europe were, that was damn near impossible to trade. Alex, Amelia, do you, or no?
Well, it was very challenging, but at the time I was at UBS on the FX desk, so you had to trade it whether or not you wanted to. So you had to execute those orders. But no, it was exceptionally challenging. Yeah, no, it was really challenging. This time is challenging from a different reason in that I wouldn't say there's more headlines, but there's never been a global pandemic in our lifetimes. Not that I don't think, right? This is the first one. So I feel like we're kind of like in an uncharted territory here. It's a weird time. This isn't a financial crisis. It's a health crisis that's impacting the market. It's very strange. It's very strange.
May I interject just for a minute on that topic there? So so the thing that gets me is we had Ebola, swine flu, avian flu, SARS-1, MERS. It's the response that the governments decided to shut down the economy that has caused this, right? We've had these pandemics. They've just never escalated to this level of response by all the countries in the world. And, rightfully so. We don't have a cure for Ebola when it was, blasting out of Africa. And it showed up in Florida, I do believe. So, I really don't understand what changed that caused such a rapid worldwide closure of the economy. Why didn't they do that for any of the other epidemics? Is really a question that to me it's unanswered.
This is my follow-up question to that, and Jim's in the office. Tell me if you know this as well. Like I'm not a virologist, but is the transmission mechanism of this much quicker, more efficient than all of the other?
I think it's a product of the fact that you can be asymptomatic and still contagious.
Right.
Yeah, but it's
and the ease of transmission, I don't think is like the others that you mentioned. Again, I'm not an expert in this. I don't know. I'm posing that question to all of you.
No, I read.
I wasn't expecting a straight answer. I'm just pointing out that the thing that's really the issue here is the closure of the economy. It's the response of the governments to close the economies, which has caused this whole recession.
Right.
Alex, go ahead.
I think your point is right. The speed of the transmission was actually what was feared the governments. And when they looked the things into China and how they contain and close the cities and how fastly it spread out, I will tell you honestly, I think my son had it here, long before, like 2 months before, and I hear from a number of bodies, they also had this type of things long ago before my country closed down. So my son was ill
I've heard that before.
in January, and we had first official cases beginning of March. And I hear some guys had it already in November. Can you imagine that?
That's amazing. But you know, guys, I would push back though. Again, Terry, I'm not coming after you. And Amelia, tell me what you think. I think they shut the government down because obviously we don't know what this thing really is, but also technology has come so far that they know, you know, even if we can't go to work with every, I mean, look at this amazing technology that 5 rookies, we didn't go to broadcasting school. Well, Amelia, you did. You learned how to be a professional. But you know, we knew we would get by because we have the technological capability to conduct our business. And and you know, and yes, the job loss is huge, but basically it's those jobs that are unable to be done so via technology. And I think that's why I said, okay.
To that point, 20 years, had this happened 20 years ago, we didn't have high-speed bandwidth internet, it would have been much worse. I really think technology has actually been a mitigator, a huge mitigator to what could have happened. Without the technology, nobody would have been able to work from home. You just wouldn't have been able to get things done. So,
I think it's important here just to recognize that you have to, in the markets especially, these are all important questions to ask as a society, and you know, to certainly debate. It's important to ask these questions. It's important to debate these questions. But when you're here in trading, it's like you have to deal with the hand you're dealt. Like, things are closed. We're in a massive global recession, maybe even a depression. Markets decoupling from that. Things are starting to reopen. So whether or not we agree with it, whether or not we like it, whether or not we think it was the right thing to do, it doesn't matter. Like, we have to deal with what we have, you know, in front of us. That's all we can do.
Yep. Bennett, jump in there and lead the interview from here if you would.
So Amelia, if you could, fill us in on what you're seeing in the markets, perhaps what you're seeing from an international risk standpoint, and we're going to go ahead and bring the presenter window over to you if you are ready.
Yeah, sure. Go ahead.
All right. If you want to walk us through some charts, it's coming your direction. What are you seeing?
Okay, so I have the Euro chart up right now. You know, overnight or early this morning, about a few hours ago, European Union announced a huge fiscal package, 750 billion euros. It still has to be passed. That's 500 billion in grants and 250 billion in loans. And this is supporting markets today. This is very, like, you know, a sugar high of new positive news. It's supporting the euro. About a week ago, Merkel and Macron from France floated the idea of kind of like a joint bond, some risk sharing among the Eurozone countries. And that was a huge deal because from the inception of the... Dude, did you lose me?
Nope, you're good.
You're back.
No,
Okay.
You're back.
Thanks. That was just a big deal for Euro because since the start of the Euro, they said there would be no burden sharing or, you know, kind of joint EU bonds. And so this is a definite change in tone, and it's definitely been supporting the Euro. I got a lot of questions last week on my seminar, my webinar that I hold on Wednesdays. People were asking me, oh, Euro's overdone, we should short it. And, you know, I just said, no, like, now's not the time to short Euro. This is incredibly positive news coming out of the Eurozone. And so we see a chart here with Euro. We have the next resistance at the 50%. It's just a Fibonacci retracement. 110.64 is the level. So just, you know, I don't want to fight Euro here. Like, I think it was Bennett said at the start, the introduction, you don't want to fight the Fed. You don't want to fight this risk-seeking move. It's my opinion, everything's kind of overdone right now, and that's a little scary because it's decoupling from the economic data, and that's uncomfortable, but I don't want to fight it. So, yeah, it's still positive on the Euro right now, and seeing if this fiscal package gets actually passed by the 27-member government. So that's the next step that we'll be looking for. That's what I'm seeing there.
Okay.
The other thing that's interesting, you know, Aussie is very correlated with, there's Aussie. It's very correlated with the S&P 500. And obviously as the S&P 500 rallies, that's taken Aussie up. And, you know, Aussie's a little bit, everything looks overdone to me. But as I said, I don't want to fight it. I don't want to try to pick a top, for sure. Don't try to pick a top. And, you know, I kind of want to ride the move. So we have next resistance for Aussie up at around 67.41 there. You see a Fibbo retracement level. And, you know, if we have a big move up in U.S. equities on the day or, in, you know, intraday, I like to trade Aussie intraday along with it and have that position off. Have it off before the market closes in the U.S. and leave it off because we get news out of China overnight that can really impact the Aussie. And the headlines coming out of China haven't been so market friendly. You know, we have U.S.-China trade war talks, and we have, you know, Beijing introducing security measures into Hong Kong. So the news out of China has not been risk-seeking supportive. And so that's why I like to have those trades off, you know, before the end of the U.S. market day. I don't want to deal with them overnight in Asia. So it's
Amelia,
interesting.
Question on that. So back in the day, I remember dollar yen perpetually, and this is going to be a little, I think you'll get it. Dollar yen was perpetually on the wrong side of the risk on, risk off trade. So how do I explain this? So as I lead into this question, what is the best risk on indicator pair right now? Is it Aussie against the dollar, or is it like Aussie against the yen? Or are we going in a different direction, maybe more of a crude oil play like Norway? Like, let me just ask that question first.
It's Aussie dollar. That's the real barometer right now, the risk seeking. If you just look at U.S. equities against the dollar index, all of the G10 is really being moved around by the U.S. dollar. So this is like almost a U.S. dollar move, with the exception of euro, because we had some positive news out of euro, which like super is boosting it today, like sugar high today. But everything else is really just a U.S. dollar move. So when U.S. equities are high, it's risk seeking, and the U.S. dollar falls. So it's really the dollar that's moving all these G10 pairs around.
Okay.
The yen usually, and the dollar is right now the preferred safe haven currency, because when this kind of crisis started, remember the Fed in March put in swap lines, US dollar swap lines with the G10 central banks, and there's a dollar liquidity shortage. That's why we got that massive spike above 100 to like 103 almost in the dollar index in March. That was the dollar liquidity global shortage until the Fed put the swap lines in with other G10 central banks. And since then, they've been able to calm it down. But that example is important. That high in the US dollar index is important because it shows that the dollar is the world's safe haven currencies. When everything was really starting to hit the fan in mid-March, when everything was closing, not only in the US, but pretty much across Europe too, because Asia had started earlier, it was the dollar the whole world sought. It was the dollar.
Got it.
And so right now, the dollar.
Sorry, just to make sure, inverse dollar global equities is a long-standing FX relationship. So are we seeing a slight inverse relationship with S&P and dollar yen? So S&P higher, dollar yen lower?
That had been working really well throughout 2019, and it's not really working right now in 2020 for the crisis. So yen is usually my preferred safe haven currency to trade. I love trading dollar yen, and that usually works really well on dollar risk like off or US equity down days.
Right.
But in 2020, since this crisis started, it's not working too well. So yen is a little bit, dollar yen's been sidelined. And it's normally not. It's normally a bigger player in the safe haven. I don't prefer it right now. I'm leaving dollar yen alone, and I just prefer the entire dollar index or something like very simple Aussie dollar. Aussie dollar is a pure like risk on, risk off right now.
Got it. That's the point I'm trying to drive at, is just dollar yen seems to be sometimes on the wrong side of the overall trade. So right now, just keep it simple is your point.
Yeah.
You know, if I mean, even like to tie it home to some equity portfolio, Alex, and I'll toss it right to you in a second, even as some people who wanted to like hedge equity portfolios, if Aussie or Norway or Kiwi are moving higher, generally we'd expect global equities to be moving higher, but maybe as a little bit of a hedge, you could do perhaps some puts on some like the FXE or FXA. So if the S&P is dropping, the Aussie dollar, Euro dollar should generally fall with the market, correct?
It's
Yeah,
usually like
that's
that, I
true.
think.
Usually like that. I mean, in terms of hedging, like equities, you could also like try to take a small position long the VIX, right? So if you're massive long equities, it's going to reverse if the VIX spikes. So the VIX is pretty, I don't want to say the VIX is not pretty low historically right now. It's just low compared to March. So, you may do a little
Okay.
long.
I can
Go
throw
ahead,
one question. So, would you agree with the kind of a underlying theme that having a global central banks almost at zero everywhere, and having basically all of the central banks are trying to push banking sector to kind of a from the monetary and fiscal side, put the money into work and economy and the debt that we're facing in the world. So we don't have an interest rate differential at all anymore present.
Right, yeah.
So taking the situation with the shortage of dollar and looking all of the currencies, would you agree that basically the king dollar will determine the next year or two in the currency markets?
I think it could. There's a couple, I tend to look at it more from, I agree with what you're saying. For my work, I tend to look at, we talk a lot about this with my clients, we tend to look at market themes, macro market themes and how they develop.
Sure.
So now that global central bank interest rates in the G10 at least are at zero, what's the differentiating factor? What's the theme that can come up and, make differentiating factors for trading G10 FX? And so one of them is our old friend Brexit. It's never done. And so right now, starting June 1, there's trade talks starting between the EU and the UK again. And remember, if you look at the G10 economies, which one is the worst? They're all bad, right? So you're picking like the worst of a bad bunch. But UK is worse, right? Because they were harmed for Brexit coming in. So they were already on their back foot coming into the pandemic, where the US economy, you could say, was relatively strong, at least compared to the UK coming into the pandemic. Business investment in the UK was tanking way before the pandemic because of the unanswered questions surrounding Brexit. Companies were pulling out of London because they couldn't get any answers on when they'd leave the EU. So now that they've left the EU on January 31st, there's still no trade agreement. And so I think the UK economically is in a worse position than other G10 economies. And I think there'll be a reckoning for the sterling at some point. So that's something I watch, very closely. I like sterling lower. As I said, I'm not going to chase it. I'm not going to pick a top right now because it's so risk seeking. But in the next month or two, when those ugly headlines start to come about trade talks between the EU and the UK, I think that'll weigh on sterling ahead. So that's one of the themes that I look for. The other theme in terms of Aussie and Kiwi is China. So, I think Bennett mentioned at the start, we're not making the targets. China's not making the targets on the phase 1 trade agreement. And now we have this intervention in Hong Kong, which the Trump administration doesn't like. Most of the world doesn't like it. And so there's real problems there from a political standpoint. And I think there could be some uglier headlines coming out of China that even in a risk-seeking market where U.S. equities are up, risk-seeking could get hit on the day by like remember back in 2019 when there was a negative trade headline, equities would be off on the day. So I think something like that can definitely come back and impact risk-seeking, which will impact Aussie, Kiwi, Canada. And just watching the oil markets have been, I'm not an oil trader, but they've been so weird, right? The negative price, now they're coming back, on the front contracts of the futures. And so oil's really been moving around. So it's been tough to trade the oil currencies right now. I've kind of left them to the side till we get more stable, I guess, oil markets is how I look at it from an FX perspective.
I agree.
Yeah. And I would just keep it
Yeah,
super liquid right now. Like, I don't like the crosses. You know, it's just, you know, when you're a trader on a big desk, that from my bank experience, people stay away from the crosses in markets that could turn illiquid. So now is not the time to get fancy with, like, you know, the crosses. It's pretty much just stay on the dollar, stay on the pairs.
Yeah, sure. I can go on and on with statements and questions with you, but unfortunately, we have a little bit of time. But we'll get along to discuss some of these.
I mean, is there anything, Ben,
sure.
do we have time for Alex?
Yeah,
question?
absolutely.
Yeah,
Please.
go ahead, Alex. You're on the spot, buddy.
I see that. Yeah, there is some of the. So I will take a screen just to show the crypto markets and some of the themes that Amelia also mentioned, Brand, a little bit more from the Elliottwave perspective.
Absolutely, we'll get you set up here.
Sure.
Yeah, look at Sterling from Elliottwave too. I'm curious to see what you think when you have a minute.
I will. It talks a little bit different, but let's look. Share screen. That's me. Coming with the charts. Okay, let's just look for a crypto market quickly. I'm gonna just look Bitcoin, but in our members area we cover lots of cryptocurrencies. And from the Elliottwave perspective, we have been looking for two possible outcomes as the preferred ones. This one is that this was a wave 4. We are up in 1, down in 2. And we are now kind of moving into a 5-wave move in the orange wave 1 of the higher degree wave 3. Okay, halving has passed. So the production of Bitcoins, it's going to go slower and slower, and the miners will have less and less to sell, which might be a very big driver if the demand comes on the upside, because there will not be much of a selling present. Okay, so this is one of the scenario. The other one, which we also track, is a very nice possible triangle, and the destiny of these two wave counts, actually, if we have a 5 waves up here, that will determine that we are most probably in a 1-2. But if we start to go down from here, which I don't think so, because if you look on a smaller time frame, there is a very nice triangle forming here. So we have a leading diagonal in wave 1, down in 2, up in 3, a sideways consolidation, which indicates we will have a almost push higher here in a Bitcoin, and then a type of a retracement we look to buy. So I think soon I will dismiss a triangle, because we need only 3 waves in a triangle. But the targets and the scenario stays pretty much. We also have some scenarios which might be very, very nasty with some type of flats, but that's for the other videos. But these two scenarios are mostly bullish for now. So on cryptos, we stay positive, we stay bullish, and we are waiting for an entry. So going back to currency markets, I'm going to show you what we are looking euro-dollar. So from the, as you know, we are tracking both wave counts. It's not much to be wise to track both wave counts, but we have a specific reason why we do so, because we actually track the sign points from the technical perspective. And I'm following this wave count for now in euro. So I think we're going to have a little bit more upside back to 116, 118 in this probable pullback, or if we get a little bit inflationary and if Fed changes its federal act and starts to basically pay government debts, which is a kind of an idea which starts to crawl into the markets, we might get even a bigger move up in euro. So I'm cautiously bullish, and I'm waiting a small pullback here while the S&P retraces. So I don't think this is still done. I think we're going to have a little bit risk-off move and dollar higher. And then I'm looking to buy this pullback in euro close to this, because this entry is really going to be a small stop loss. So I think it's going to be a good one. Aussie, it's looking very bullish. This is a very nice Elliott wave move after a very big fall. So if you look from 2011, this is also a chart which indicates we might get a lower dollar, because either you count this impulsively or you do a complex correction. From 2011, we get a big move down, and from lows, you have a nice 5-wave Elliott sequence on the upside without overlap. Okay, so from technical perspective, this is telling to us that we're going to have a pullback with the S&P as a risk-off move, and then we're going to continue higher with the S&P, either in an ABC or even more impulsive move on the upside. So I'm also bullish as Amelia, a longer term, and I think it's going to be a really good midterm entries in Aussie.
Alex,
On pound, quickly. Okay.
Take a breather just a sec. Let's bring our guest back in here. Alex kept mentioning he's looking at a big move, Amelia, in Aussie, in the euro.
No.
Where are you from an inflation, persistent underlying deflationary forces as it relates to gold? We're getting a couple viewers in the room here asking. Do you have an opinion on gold that you'd like to talk to?
I look at gold as the safe haven of last resort, meaning in currencies we have dollar is a safe haven, yen is a safe haven, which we talked about. I don't prefer it right now. Swiss franc is a safe haven, which I don't like because I worked at a major Swiss bank, and Swiss central bank SNB intervenes in the market, so I stay away from Swiss right now. They're going to intervene in it. And gold is your last kind of safe haven. And gold is always the safe haven of last resort. And what do I mean by that? I mean, when everything is going wrong around the world, which it is, every single economy, developed economy at least, is in, recession. And, you see the EM market isn't doing well either. People flock to gold. So from that perspective, I just think gold will continue to outperform for the next, I think, 2 to 3 years, just because it is the safe haven of last resort. And maybe the markets are stable, but this recession isn't going away anytime soon in any country. This recession is going to be with us another year. Hopefully that's all, maybe more, but hopefully a year. So yeah, gold should continue to outperform for sure.
Safe haven of last resort, but outperform relative to what?
I look at gold not intraday. I look at it as a long-term investment. So something that I really hold like in a retirement account for, 5 years, a decade. So I always think of gold as a very long-term thing. When I trade gold, I'm not like in and out of gold. It's a buy and hold for me. And it makes sense to me in this environment where everything is going wrong around the world, because it is. We have geopolitical risk, we have trade war risk, we have pandemic risk, we have recession. I mean, now is the time for gold to shine, no pun intended. But yeah, so the longer term, deflation, inflation. Yeah, I mean, we're in a deflationary environment that could suddenly turn inflationary, but that's not for this calendar year. That's further out.
Yeah,
and right now you just have to, if you're trading, especially as an individual investor, not in a retirement account, you have to focus on what's now, because headlines are coming so quick every day. You have to focus on now. You can't focus on, you can't focus on the inflation deflation right now, but you can trade that ahead. Yeah.
Very good. Alex, you want to go ahead and bring that chart of gold back and give us the count there now that we've brought that back in?
Yeah, let's look at it.
Yeah, okay, so...
Oh, it's going higher and higher. Look at that. Is that gold?
Yeah, so gold...
When it gets to 5,000, Amelia, we're going to ask Peter Schiff to come on, because I think you and I both spoke to him on the Money in Motion show.
Yeah.
Okay, so except from the event risk, and the gold is also looked as a safe haven, but rarely we have seen gold and dollar trade together. But anyhow, we have been very bullish on gold from here, if you remember, Todd, and I think we did some trades with the members as well.
Yep,
and we got to the target. We got to the target, a very beautiful target, where the 786 retracement and the 618 5-1+3 met there, and we are still holding this level, which is very, very interesting thing. So from technical perspective, we really can go both ways. So I'm just telling you from the Elliottwave perspective. I'm looking higher on gold because I like more this technical chart than the other one, because we have a very nice defined channel, a very nice Elliott wave count. So will be my do or die levels on gold here. And we are going lower now in an A, up in B, and down in C for a three-way pullback for a possible green wave 3, which gonna accelerate higher very swiftly. So this is a do or die, because if you have a wave third of a third, it's gonna rock and roll higher. It's not gonna be a slow move. So this is going to be my key area. And if we drop below it, definitely gold will continue at least a little bit more lower, and it's going to continue probably sideways technically. But for now, I'm looking bullish, and this is my basically a pin buy point here for a possible wave 3 of 3. Stops are very small, so it's a very small risk compared to the gain if the gold continues from the technical Elliott wave perspective on the upside. So I like this risk, I like this chart, and I like support levels. And I like the team, as Amelia says. So all of three aligns for a possible buy on gold here, from my perspective. Also, if you look silver went abruptly up as well. So I'm also looking for a possible Elliott wave pattern here, which is known as a flat. So on a weekly chart, it will look like this. And we have already a nice 5-wave impulse from the highs. So we have a 5 waves down in A, 3 waves up, 3 waves down in B. We reached 127 ratio, which is the usual for A versus B, and now we are moving impulsively on the upside. So this can be a long triangle as well, but if we surpass 20, 18, 20, 21 after a pullback, definitely we're going to continue higher with the gold and silver reaching in the next year even higher levels.
I think it's interesting. We've talked a lot about, euro higher and Aussie higher, and it's risk seeking with the S&P 500. And I just think, and I don't want to fight the move. Like you guys say, it's not good to fight the Fed. Don't fight this move. I'm wondering though, when we look at most things higher, what can reverse this? What can really take this risk seeking in the market for equities and I guess euro and Aussie off? What can get that off the table? And I guess I'm just a little worried about two things: the decoupling of the financial markets and the economy. The second thing I'm worried about is the lack of positive impact from announcement effects. So when the Fed comes out and announces their program, that rallies the market. There's an announcement effect and there's a follow through by the Fed because they implement the program that they announced. And there's not much more that they can announce. There's not much more that they can, not many new things that they can announce. And so I'm wondering if that announcement effect wearing off will start to wear on the market. I just think there could be a reckoning, but I'm not sure when. It doesn't mean that I want to fight these risk-seeking moves, because I don't think you should do that. But it's just something to keep in mind as you're trading. What could flip this market? And because if it flips, it's going to flip real quick. So I mean, it's just something to think about.
This is why I think we always, for all of us, regardless of where we wind up 10 years from now, 20 years from now, we're always going to keep a grounding in price action and what the underlying market is doing. Because, how many different ways did they explain that recession was imminent, even from the biggest global macro hedge fund managers in the world over the last 2 years? And they had all these different reasons as to why recession was coming in. As Josh Brown said, which I thought was pretty funny, typical of him, somebody ate a bat in China. Like, who had that one? So you never get hit by the train you see coming. And I think, this market is so risk-seeking, even pre-COVID. We're seeing that dynamic continue here, discounting in the face of massively horrible data. You never know what the market is really discounting. I think why we're acting so well in here. And two, what will finally derail this market? I just don't think you can know. And if you do, you get a movie with Christian Bale and a couple other famous guys playing you if you happen to get it right. So that's why, just from my point of view on the money management side, like I think you just have to have a lot of respect for the underlying technical trend, be aware of what's being said out there, but probably know you're not going to see or know exactly, what number train is going to run you over. That's just my contribution.
Yeah, I mean,
No, it's
as we
right.
talked yesterday, as we talked last time, Todd, I mean, if we go finger by finger in the last 2 years, what has been thrown on these markets?
Right.
It's
Yeah.
really two hands is not enough. Okay.
You're right.
So
You're right.
I mean, and it's
Yeah.
keep going up. So as Amelia said, as you also underlined even before, I'm not going to look to short the market anymore. Definitely,
No.
until I see a clear sign of technical perspective and Elliottwave perspective to do that. So this market was so resilient, and it keeps going up. For me, it's really kind of a Disney World event, and it's like one of the movies when you throw everything on this McClane guy in a Die Hard movie, and he just resists, the bombs. He
I love
resists
it.
the atomic bombs, He resists everything. He's a barefoot walking on a glass, but he still fights and he beats them all over, So I look at these markets at John McClane, definitely. So no fight
It's
with
important.
it, so,
Yeah, it's important what you guys are saying, what Todd said, what you're saying, Alex, to really get a feel for how something is trading on the day. And this really reminds me of the flash crash in 2010. The May 6th flash crash in 2010, but the equity market crashed. And I was on the trading floor that day in UBS, and I've never seen anything like that day. But I'll recount that day very briefly for you. Obviously we're in front of our screens all day. We have everything going. We have everything up. And it was really interesting because that morning, the traders, everybody on the trading floor, no one felt comfortable with the price action. The event happened later in the day, but in the morning, everybody was uncomfortable with kind of how everything was trading. Nothing felt right that day. The trading was not good. All the traders were uncomfortable. We knew something was coming because of how the prices were behaving, but we didn't know what was coming. And I remember there was a huge dollar-yen move earlier that morning, and our technical strategist on the floor was pointing that out, and clients started to call from hedge funds, why is it trading like that? Dollar-yen isn't behaving how it normally behaves. We're so uncomfortable with this price action we're seeing, and are you guys, they call us and say, are you seeing something? Are you executing orders that are making this happen? And we're like, no, but everybody was like, it's just trading heavy, it's just trading bad. And later in the day was the huge crash, but the price action was off in the morning, hours earlier. And so I think that kind of speaks to what you said, Todd. If you constantly watch the underlying price action, you can if something feels off in the market. You have to be experienced and have a long trading history to do that, but if you don't have that, start today. Start watching very closely the intraday moves and seeing how things are trading and seeing if they feel off to you, or if the market feels heavy, or if the market feels up, or maybe one day, for instance, what if equities are up but Aussie feels heavy? That's a bad sign. That's a price action out of line. So something like that. But this reminds me of being so uncomfortable, and it was all the traders, equity traders, fixed income traders, currency traders, because UBS, we sat in a huge trading floor, not anymore, but at the time we did on May 6, 2010, and everyone was uncomfortable that morning, and nobody liked the price action. So
the takeaway too.
I agree.
Go ahead, Alex.
No, just want to point out what you have said. We have been looking also, as Todd was very successful FX guy before, but even before October, we was looking signs on the dollar yen, and we are mostly based so technically and grounded in technical analysis that many things can be seen front if you have a reliable pattern and a good analyst. So even before October, me and Todd was discussing, and we saw a possibility that dollar yen might drop and that can relate to equity markets. If you remember that, Todd, which on the end happened. We didn't knew the timing. Even we had the setup on the S&P, which we followed very long, but the move was a little bit extended, so we kind of start to mixing it with the bullish outlook. But we were right on this market year and a half ago. In most of the cases, if you remember, guys, Todd, your triangle from 2018 was actually from 2018, if you remember.
Yep.
So we have been spot on. So I think the technical things can really give you the underlying theme and can really give you a little bit of warning in advance, especially from FX side, what you're saying. So it's already set on the FX side in some pairs which are risk off, and you can kind of smell it. So it's a good barometer, I think, as well.
I think to pull what Amelia said and Alex said together, you know, Amelia said watch it on the intraday time frame, watch how market's trading, but also then watch the news flow of the day. And I think it works with intraday trading. I also think it works from position trading. And now, you know, I'm holding much longer term portfolios, and I'm still watching the news flow. Watch how the news flow impacts the markets. Like there's two sides of this: what's actually happening in the market and what they, in quotations, financial media, publishers, people like us, are saying, you know, should be happening. What's actually happening versus what should be happening. Like, watch the news flow right here. So we've had the beaten down sectors like travel, leisure, even airlines, even cruise ships acting strong in here. The NASDAQ right now is down 1%. Well, the Dow was up 1%. I mean, that's a pretty big divergence right now. Watch the news flow right now as they start to, and I say they, start to assign reasons why the NASDAQ is starting to sell off technology. They are going to find reasons why technology is selling off. And all that's going to do, make the S&P respect the 3090, which is the 786 retracement level, which is what I mentioned on TV yesterday. And then as you know, the rest of the travel stocks fall behind technology, watch the divergence of NASDAQ technology come back as the stocks that were down prior are pulled down. Watch the price action lead the underlying change in the improvement of the technology stories once the S&P has responded to the 786. So you just got to watch the diversity of what's actually happening, what they report should be happening. And it's important to know what the news flow is, but that's how you trade, that's how you position trade, that's how you be aware of the fundamentals, but also let the market be your guide. Because I don't know, I mean, we've all been doing this a long time, and I'm pretty sure at this point that the market is the smartest indicator. That hard red edge of the chart's the smartest indicator out there. I haven't seen a lot of fundamental guys who are just completely slaying it and just being devoid of knowledge of price action.
Very good, guys. Now go ahead, Alex, and then we'll wrap it up.
No, I just said Die Hard team for me, so I'm watching the movie.
Guys, if you want to check out more of what Amelia has to offer, thank you very much for joining us on the show once again. We've had her in the past. Yeah, it was a pleasure. It was absolutely a pleasure. You can go to marketcompassllc.com if you want to contact her there in the upper right-hand corner. Guys, thank you once again for tuning in. If you enjoy the content, please give it a thumbs up, subscribe with notifications. It helps the YouTube algorithm know that you're enjoying the content and gets it out there. And if you're interested in more of what we do at Trading Analysis, you can visit our website as well, tradinganalysis.com. Thank you, guys. Appreciate it. YouTube, be safe. Everybody keep your eyes on the market. Todd, Terry, Alex, Amelia, good work, guys.
Thank you.
Be safe, and we'll catch you guys next week.
Be sure to go check Amelia out at marketcompass.com. We'll have her on again many times, so thank you.
Marketcompassllc.com.
Guys, thumbs up.
See you guys. Take care.